While you were sleeping, a quiet reset may have moved one step closer, not with tanks or missiles, but with metal, invoices, and supply chains. And the reason you're suddenly hearing whispers about silver in the same sentence as global power is because 2026 could be the year the world finds out whether silver is just poor man's gold or a strategic choke point hiding in plain sight. Stick with me for the next few minutes because I'm going to connect dots that most people only see separately. Russia and China pushing trade away from the dollar, the world stockpiling gold as a political insurance policy, and the weird reality that the most important metal for the energy transition might also be the easiest one to squeeze. And before anyone types conspiracy, breathe. This is not a secret cabal story. It's an incentives story, it's a supply story, it's a geopolitics story, and it's a what happens to you story. Because whether you care about markets or not, the price signals for metals eventually show up in jobs, electronics, solar, cars, and the cost of living. Let's start with the big question in the title. Is silver the new gold? Most people hear that and think one of two things. Either it's hype from the internet, or it's a fancy way of saying silver might go up. But the deeper version is this. Gold is the traditional reserve asset. Central banks buy it, countries hoard it. It sits in vaults as neutral collateral when trust is low. That's why de-dollarization, the slow move by some countries to reduce reliance on the US dollar, has been closely linked to rising official sector gold demand. Even big banks describe gold as the clearest reserve alternative when nations diversify away from dollars. The twist is that silver isn't just a mini gold. Silver is half money, half machine. Gold mostly sits. Silver gets used, consumed, scattered across billions of devices and panels and sensors. And once it's used, a lot of it is hard to recycle economically. That's not a vibe. That's a supply chain reality. And it's why analysts keep pointing out that industrial demand is a large share of total silver demand, with photovoltaics a major driver. Now, here's the first retention key. Russia and China don't need silver to replace gold. They need optionality. If you want to understand their strategy, you have to stop imagining a single dramatic announcement, like new currency backed by silver, and start imagining dozens of smaller moves that add up to one outcome. More trade settled outside the dollar system, more domestic control over payments, more leverage over critical inputs, and more ways to keep their economies functioning under sanctions, tariffs, or financial pressure. We already have clear evidence that Russia and China have pushed hard to settle bilateral trade in their own currencies. Russian officials have publicly said the vast majority of settlements are in rubles and yuan, not dollars. That matters because once trade and payments shift, the need for dollar reserves shifts, and when the need for dollar reserves shifts, countries look for alternatives they can trust in a crisis, like gold. That's the first half of the chessboard. The second half of the chessboard is the part most people miss. Industrial metals are geopolitical now. In the 2000s, power was about oil and gas. In the 2020s and 2030s, power is also about semiconductors, batteries, and the raw materials that make electrification possible. Silver sits at a strange intersection. It's precious enough to be hoarded, but industrial enough to be indispensable. And the International Energy Agency has warned that silver demand for solar manufacturing could be a very large share of global silver production as the world scales solar, which is exactly the kind of bottleneck that turns a commodity into leverage. So what does a Russia-China silver strategy even look like in a world where gold is the classic reserve metal? It looks like three layers stacked on top of each other. Layer 1, payments and collateral. When countries reduce dollar settlement, they look for collateral that is hard to sanction, hard to freeze, and recognized globally. Gold is king here because it's already accepted, and central banks already treat it like money. That's why you see de-dollarization narratives and gold buying moving together. But silver has a role in collateral too, especially in private markets and in trade, where smaller counterparties don't have access to gold. Silver's lower price per ounce makes it easier to move in smaller lots. And in periods of distrust, people historically gravitate to tangible assets they can hold. That's not a guarantee, it's a behavioral pattern. Layer 2, supply influence. China is a manufacturing superpower, and manufacturing leverage is about inputs. If you are building solar panels, electronics, connectors, sensors, medical equipment, or data center hardware, silver shows up more often than people realize. The Silver Institute, Zone Supply and Demand Reporting, has highlighted how industrial fabrication has been a major pillar of demand, with electronics and electrical demand strong and solar a key growth engine. If China can shape the flow of critical materials through export licensing, quotas, inspections, or just administrative friction, it can shape global prices and global production schedules. Whether you call it policy or strategy, the effect can be the same. Tighter availability outside China, higher premiums in physical markets, and more scramble by manufacturers to secure supply. Layer 3, narrative and psychology. This is the part YouTube loves, because it's where charts meet human emotion. Gold has a simple story. Fear goes up, gold goes up. Silver has a messy story. Fear can push it up, but recessions can pull industrial demand down, and big players can whip it around. That volatility is exactly why silver can explode in attention when it moves. If you're trying to shift perception, you don't have to control the market. You just have to create conditions where the market feels unstable, where headlines get loud, and where people start asking, why is this happening? That question is the oxygen of virality. Now, let's get specific about 2026, because that's what you came for. I'm not going to pretend I can predict prices, and this isn't financial advice, especially if you're under 18. Talk to your parents or qualified professional before you make money moves. But I can lay out the mechanisms that could make silver behave more like gold in 2026, and the mechanisms that could make it crash your expectations. Mechanism A, the industrial squeeze. Solar is scaling fast globally, and silver is one of the materials that solar manufacturing depends on. The IEA has explicitly warned that solar-related silver demand could become a very large share of global production by 2030, which implies that supply tightness and price spikes are not crazy outcomes in a rapid build-out. Add EVs, power electronics, and the build-out of data centers, and you get a simple reality. Even if the world wants to use less silver per device, total units are rising. This is the more efficient but more everything trap. Mechanism B, the policy squeeze. When a major hub changes how it handles exports of a material, through licensing or restrictions, it doesn't have to ban exports to cause turbulence. It can slow flow, increase paperwork, create uncertainty, and uncertainty is enough to move prices. If rumors become policy and policy becomes delays, manufacturers react by stockpiling. Stockpiling is what turns a normal market into a squeeze. Mechanism C, the trust squeeze. If global politics stays tense and more countries feel the need to diversify reserves or settlement systems, silver gets pulled into conversations it normally doesn't belong in. Gold is the official reserve metal, but silver is the popular precious metal that retail crowds can access. When trust drops, both can rise together, and that's when silver starts to look like gold on a chart. Here's the weird part. Russia's role might be less about making silver money, and more about being a swing player in the physical market. Russia is a major commodity producer, and Russian officials have discussed precious metals as part of broader resource strategy. Russian state media has reported on rising silver reserves in terms of geological reserves and mining dynamics, and analysts have discussed the possibility that Russian official sector activity could matter for silver even if the scale is smaller than gold. The point isn't to treat every report as destiny. The point is that if even a few large players decide silver matters strategically, the silver market's size makes it sensitive. Gold is an ocean liner. Silver can be a speedboat. It doesn't take as much new demand to change the balance. So, is silver the new gold? Here's the honest answer. Silver CA can't replace gold as the primary reserve asset because gold's entire advantage is that it is mostly not used up. Central banks love that. But silver can become the new pressure point, and pressure points are often more important than symbols. Gold is the flag. Silver can be the lever. Let me show you what that looks like in a simple domino chain. Domino 1, Russia and China increase non-dollar settlement and build payment routes that don't rely on Western rails, reducing the necessity of dollars in certain trade corridors. Domino 2, countries and institutions respond by holding more neutral reserves. Gold first, but also other assets that reduce exposure. Domino 3, industrial build-out accelerates, solar, electrification, data centers, increasing baseline silver demand. Domino 4, policy changes or supply disruptions tighten physical availability, creating premiums in spot markets and panic buying by manufacturers. Domino 5, retail investors notice the price spike, headlines go viral, and the psychology loop kicks in. At that point, silver can trade less like a quiet industrial input and more like a monetary panic asset, at least for a while. But now, pause, because if we're being serious, we also need the bull case for gold, bear case for silver. Reality check, because that balance is another thing the viral scripts do well. They make you feel informed, not just scared. Silver is famous for fake-outs. The same volatility that makes it explode also makes it punish latecomers. If the global economy slows hard in 2026, real recession, not just soft landing talk, industrial demand can dip and silver can fall even if gold holds up. If manufacturers find ways to thrift silver, use less per panel, switch designs, improve recycling, tightness can ease. If the US dollar strengthens sharply, precious metals can face headwinds because they're priced globally in dollars. And if a squeeze narrative pulls in too much leverage and too many speculators, margin hikes and forced selling can create brutal drops. In other words, silver can feel like gold on the way up, and feel like a trap door on the way down. So how do you actually analyze the Russia-China strategy without getting lost in hype? You watch 5 signals, and if you remember nothing else from this video, remember these 5, because they turn noise into a dashboard. Signal 1, settlement shifts. When major trade corridors keep increasing local currency settlement, it's a sign that the dollar's role is being bypassed at the margin, and that changes reserve psychology over time. Signal 2, official gold behavior. When central banks continue accumulating gold, it suggests persistent demand for neutral reserves in a tense world. Signal 3, industrial demand data, tracks solar deployment forecasts and silver industrial demand reports. Industrial strength makes squeezes more plausible. Signal 4, policy headlines from major refining, manufacturing, and trading hubs. Anything that changes how fast physical metal can move. Signal 5, physical premiums and inventory. Futures markets can be loud, but when physical premiums rise and inventories tighten, that's when the real stress shows. Now, let's bring it home to you, because geopolitics feels distant until it hits your phone bill, your laptop price, your electricity plan, or your job market. If silver becomes a pressure point, it can do 3 things. First, it can raise input costs for industries that use it, solar manufacturers, electronics producers, auto suppliers, which can ripple into higher product prices. Second, it can encourage substitution and innovation. Companies will try to reduce silver loadings, redesign contacts, or shift to different materials where possible. Third, it can amplify volatility in markets, which affects sentiment and risk appetite broadly. You might not trade metals, but you live in the economy metals build. And here's a question that most people do ask. Why would China and Russia prefer a pressure point over a new currency? Because pressure points don't require global agreement. A new currency requires trust from many countries, rulemaking, enforcement, and stability. A pressure point requires only that you influence a bottleneck that others need. If the world wants more solar and more electrification, and silver is a key ingredient, then anyone who can influence silver supply chains has leverage without printing a single new banknote. That's the strategy logic. At this point, you might be thinking, okay, but is there proof Russia and China are doing this together with silver? The honest answer is, there is stronger public evidence for the payment and currency side of the story than for a coordinated, explicit joint silver plan. The trade settlement data and statements are clear. The industrial demand pressures are clear. The leap from those realities to they are executing a silver squeeze is an inference. Sometimes that inference will be right, sometimes it will be wrong. But the reason people are talking about it is because the conditions that create silver squeezes, tight supply, rising industrial demand, policy friction, and distrust, are all plausible heading into 2026. And when multiple plausible factors stack, markets get jumpy. So what should you do with this information? Not buy this, sell that. What you should do is stop being surprised by the headlines. When you see a sudden spike in silver, don't just think meme. Ask, did physical premiums jump? Did inventories drop? Did policy change? Did a major hub tighten exports? Did solar deployment forecasts increase? Did geopolitical risk rise? Those questions turn you from a passenger into a driver. And if you're someone who likes to think ahead, because that's what this channel is about, here's the scenario map for 2026 in plain language. Scenario 1, the silver is lever year, industrial demand stays strong, policy friction tightens physical flows, and silver trades with a monetary premium on top of industrial demand. Gold stays strong too, but silver outperforms because it's smaller and more volatile. Scenario 2, the gold wins, silver whipsaws year. Geopolitical risk stays high. Gold holds up as the clean hedge, but industrial growth slows or manufacturers thrift silver, and silver becomes choppy. Scenario 3, the everything cools off year. Global tensions ease, the dollar strengthens, rates stay high, and both metals lose momentum. Scenario 4, the shock year. A sudden geopolitical escalation or financial accident spikes distrust, and precious metals surge together until policymakers respond, then volatility explodes. Do you think the next decade is about cooperation and stable trade or about blocks and leverage? If you think it's blocks and leverage, silver starts to look less like jewelry and more like infrastructure. If you think it's cooperation, silver is still important, but it's just a commodity, not a weapon. And here's the final twist. This is the part I want you to remember when you close this video and go back to your life. The Russia-China strategy. Isn't it one plan? It's a direction. The direction is reduce vulnerability to Western financial pressure, increase control over payment rails, increase resilience through real assets, and increase influence over critical supply chains. In that world, gold is the symbol of sovereignty, but silver can be the hidden hinge that swings entire industries. That doesn't mean silver will only go up. It means silver matters more than it used to. And in markets, mattering more is often the first step before moving more. And remember, markets can be noisy and headlines can be wrong, but physics, mining timelines, and supply chains don't care about opinions. So here's my question to you. Drop it in the comments, because I read them and because this is the real debate. If 2026 gets tense, do you think people run first to gold because it's the classic reserve, or to silver because it's the metal that the modern world literally burns through? And if you want, I'll make a follow-up video where we break down the 5 signals week by week: settlement shifts, gold behavior, industrial demand data, policy friction, and physical premiums, so you can see in real time whether silver is turning into the new gold or whether it is just doing what it always does, seducing everyone on the way up and punishing everyone who confuses a spike with a strategy.